Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So again, 1.00 would be a perfect correlation, and negative 1.00 would be the inverse relationship. The efficient market portfolio theory states that rational investors should seek to buy undervalued assets with low correlations with your existing assets. An example would be an example with a high negative correlation is commodities to bonds. Again, normally bonds do poorly during periods of inflation, but commodities are going to do well. So here, what I'm trying to show, slide 50, is that here's the relationship of X to Y. So two different variables. Now, what it's trying to show is, and this is husband's age, wife's age. So, yes, you could come up with an example that somebody that would be very, very young would marry someone very, very old. But in general, this is a nice way to look at it. In general, the older the woman is, the older the man is in general. So you're going to see that relationship, one versus another. So they're not going to be inverse. They're going to have a pretty steady relationship. But they're not going to be perfect, as I said, because here a perfect correlation would mean that every woman or every man would marry someone exactly or very much near the same age, and we know that's not always true. So there's the perfect, at least according to a theory, when X increases, Y increases. And negative would be the opposite. So think of it from the practical standpoint. Negative would be owning an oil stock and an airline stock, or bonds and commodities. That they would work pretty much in a negative way. No correlation could be many assets that basically are not affected. So sometimes they may move with that other asset, or sometimes they may move against it. So essentially there isn't any correlation, and that's a scattering, and that's why, according to statistics, you're going to want to have more of a line, a linear relationship. And obviously, on slide 53, there isn't any linear relationship there. So if you take a look at this slide 54, equity volatility tends to be higher than currency volatility, and that would make sense. In fact, I'm going to show you a couple examples in a second, but we know that FX volatility does not get to be the 90, 100, 150, 200 volatility that we've seen in a lot of financial stocks recently. So equity vol tends to have the highest vol, and then you could look at the Australian vol, which is going to be pretty high, and you could look at Japanese yen, which some periods Japanese yen was highest, and some periods Australian dollar. So right now we're in the period that the Australian dollar is actually exceeding the Japanese yen. So we're looking at rolling 5-year correlation of equity and currency returns. So what we're seeing here is that we have positive correlation between the yen, have less diversification. If you look at the opposite way, which one does not have any correlation, and that's what's been happening recently. So we see the U.S. dollar against the Japanese yen, they're going to move pretty much alike. When I'm saying the U.S. stock market versus yuck. But then when we look at negative correlation, we're looking at the Australian dollar, where the U.S. stock market is moving down, but the U.S. dollar is moving up. And it's important to understand these, and in fact, you can actually implement options strategies. Now, this isn't perfect like any kind of methodology. Nothing will be perfect, but at least you can understand that this is out there, and you may want to start thinking at a more overall portfolio approach for your investments. So correlation, assuming you have a favorite option strategy, even though we know that option strategies, all option strategies work, they just don't work all the time, and that's important. The last year or so, covered call has not worked. At some point in the future, covered calls or selling options will probably be very, very good strategy. But right now, it's been a very poor strategy. Why? Because the market is moving in such large moves. So most equities and ETFs are lower in price in 2008. Equity volatility is slightly lower, and FX volatility is far from its peak levels. Well, I should change that actually because it depends on the currency you're looking at. FX volatility, the yuck is probably way lower than it was. We weren't trading the yuck in 1997, but yuck traded at about 40 volatility then. Now it's only trading in the 20s. But Australian volatility is probably trading near its record highs because it's just taken off in the last couple months. So let's take a look at what's going on in the price action. So this is interesting. What's happened in SPY versus yuck? Well, there's the correlation. You see that the U.S. stock market and the dollar against the yen. So the yen's going to have the inverse relationship. So the dollar is going to move very much like the U.S. stock market, at least against the yen. So the U.S. stock market in the last 10 months or so, down 33%. I'm looking at that last column. Dollar yen down only 8.5%. But then if you want to look at the others, and when I'm saying the non-correlated pairs, well, look at what's going on. Stock market down 33%. Dollar up almost 9% against the euro, 18% against the Canadian dollar almost 15% higher against the British pound. And believe it or not, the U.S. dollar is up 36% against the Australian dollar this year. Of course, it depends on the day that you look at this, but, this is amazing. So what you're seeing is that chart when we showed that the Australian dollar definitely has, if you look at that correlation, you're going to see a negative correlation of the Australian dollar. So any of us, if we had seen this late last year or early this year, you could have realized that buying calls in AUX could have been a hedge for your U.S. stock portfolio. Again, will it always work? No. But should you consider this? Yes. Because correlations do change. So let's get back. So that's quite interesting to see what's happened over the last 10 months or so. And here are the vols. So I built this presentation about 3 months ago, 2.5 months ago, and the vols were all pretty normal. I say normal, dollar yen, 10%, dollar Australian, 9%. And I looked at it just recently, about 2 weeks ago, or actually a week ago. Yuck trading 25 vol. The AUX is trading at a 38 vol, which is incredible. But then if you look at it relative to the SPY, well, that high isn't even right because the new high is now, it used to be the high was 30, but recently we traded at 61. So everything's elevated. It's just, relatively speaking, you'll see that the U.S. dollar has been very volatile, but especially so against the Australian dollar because the Australian dollar is so weak. I guess the two highest vols, as you could see, are the AUX, I guess you could say the Asian currencies, the AUX, which is the Australian, and then the Japanese yen. And the one that moves most like the U.S. dollar would be the Canadian dollar, although we've had guests on, the last couple of guests on the ISE webinar series that said that they thought that volatility may even pick up more. So, again, I don't know if that will occur, but recently the Canadian dollar has exemplified the lowest volatility, and we'll see if that actually picks up. So which strategy should you implement? Well, you can take a look at all kinds of different strategies. And, I try to color code these, but again, if I'm bullish on a dollar, I could be buying calls. I could be buying call spreads. I could even be selling put spreads. If I was bearish on the U.S. dollar, and Jason Ayers is going to be on next Thursday talking about this also, but this slide 59 you may find it's helpful. Because when you're thinking about it, you're bearish on the U.S. dollar, you'd be buying put spreads, or maybe selling call spreads. And the strategies have been working recently. If you had believed in increased uncertainty, you could be buying both calls and puts. This would have worked really well a couple months ago. Problem is now the premiums are so high. You could sell call spreads or sell put spreads. If you think that volatility is going to decline, you may want to buy call spreads, buy put spreads, maybe even calendar positions. So there are a lot of different ways to trade FX options. All strategies work. They just don't work all the time. Each option strategy requires a forecast of the underlier, the exchange rate, magnitude, meaning how far is it going to move, timing. Most importantly, investors should understand the advantages and disadvantages of every option strategy prior to implementing the strategy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.